Good evening, ladies and gentlemen. This is Barry Norman on behalf of X90, and welcome to our class, Foundations of Forex. Tonight, we're going to be talking about what in general Forex is, or what currency trading is. And tonight's class is brought to us by X90 while powered by investing.com. X90 is one of the world's leading online retail trading providers. They offer stocks from around the globe as well as currencies, commodities, and indices. You can trade Forex through their CFD platform. You can set up a demo account and try Forex trading. All it requires is a few pieces of information, no credit card, no deposits. And you can get a bonus when you're ready to start trading. You can download, there's no downloading their web trader. And you can fund your account when you're ready to go to real money for as little as 100 euros. And you can trade CFDs for stock, Forex, indices, and more on their platform. So let's go over to the X90 platform because we're going to use that a little bit tonight in our class, because in understanding what Forex trading is, you have to kind of understand what spreads and how to do buys and sells and stop losses. And so let me show you some of the examples on the platform, and then we're going to talk in great depth. But one of the best concepts that you have to know, and one of the most important concepts you have to know in understanding Forex, is what a spread is. And I'll show you how to find it or see what it is right on the platform. So let me bring up the platform on your screen. Let me get logged in. Security logged me out because I have it live in the background. There we go. Now, we're going to be talking about spreads in a few minutes. Spreads are very important to understand. And if you notice, what I've got up here on the platform now is the currencies that are available to be traded on the platform. And we're looking at the euro. There is a price if you want to sell euros, and there's a price if you want to buy euros. Sometimes this is a difficult concept for beginning traders to understand. And the difference between the buy and the sell is called the spread. And we're going to go into detail about what a spread is. But just imagine if you were going on vacation and you live in London and you have pounds in your pocket and you're going to Australia, so you need Australian dollars. When you go to the post or the bank or the currency stand, they're going to offer to buy those pounds for you for a certain price in euros. Either they're buying those euros. What you're doing is you're selling them you're selling them your pounds and you're buying euros. And there is a price. Today they don't charge commission. There's just what they call an ask or a buy price. And when you're there, you're going to see two numbers up on the wall. One that they'll buy them for and one that they'll sell them for. Okay. The difference between what you buy and you sell is in the old days, it was almost called the commission. Today, in this kind of trading and even in the currency places, it is called the spread. Okay. In other words, if you went into the bank and you said, I want to trade pounds for Australian dollars, and you gave them 1,000 pounds and they gave you back the Australian dollars, okay, you would get whatever they were selling Australian dollars for. Now, you're standing right there and your wife calls you on the phone and says, honey, we can't go on a trip this year. Something happened in my office and we got to put it off for a while. So you turn back to the teller in the bank and you say, you know what, give me back my pounds. She says, well, we can buy back your pound. We can buy those Australian dollars for you. And you're going to find it standing there over those few minutes, you lost a couple pounds. And it's the service fee, more or less. It's any way you wish to describe it, but it's the difference between the spot price, the price it actually is, and the price they're willing to buy and willing to sell. But remember this concept when we go talk about spreads and what's important when you're trading Forex. Can you hold on again? There's somebody out here who says they can't hear anything and they don't understand there's not much I can do. Sorry about that. So let's go back over to my PowerPoint But just remember this when we go over to talk about the spreads. Now also, we're going to talk about tonight about stop losses and types of orders and where to put your positions when you open a trade. And there are different types of ways that you can protect yourself from loss or from too much loss. And this is called stop losses. And these are where you would put your automatic, if the asset moved against you, the currency moved against your position, you could stop it from, you can automatically, when you're opening your position, you can put a stop loss so that the computer automatically closes your trade if it starts moving against you. Also, there's a take profit point where as long as you say ahead of time, I'm willing to take profit if the euro goes up to this price because you're more than content, the system will automatically, when the euro hits that level, sell it and put the profit in your account. And these can be adjusted continuously throughout the trading session if you wish. But there are many ways that you can protect yourself from high loss. Now, if you don't know anything, and if you're new to Forex trading, what you should do is go to www.x90.com and just click on the demo account. They'll ask you your name and email address and to pick a password, and you'll have a demo account just like I have in front of you. And also, if you come down here and click on Start a Tour, it'll walk you through the whole platform with step-by-step guides. And it will also, if you want to also learn how to actually make a trade, you can do that, and you can also follow a guide in opening a position. They'll walk you through and tell you everything. So, you know, in a demo account, you're not putting any real money in there. So you can try it all you want. There's no charge for it. There's no other details. There's no credit cards required. There's not any documentation required. So you'll be able to open up, and you can actually open it now and follow us along in class. Okay. So let's go back to my PowerPoint, and let's really start talking about what Forex is so you can understand a little bit better what this stuff is that you're thinking about investing in. Now, basically, the Forex market is where banks, businesses, governments, investors, and traders like you and I come to exchange and speculate on currencies. The Forex market is referred to as the FX market, the currency market, the foreign exchange currency market, the foreign currency market, and it is the largest and most liquid market in the world with an average daily turnover of $7 trillion. That's a big number, $7 trillion per day. The Forex market is open 24 hours a day, 5 days a week. There is no Forex trading on the weekends. And if you're in certain countries, whenever it's a central bank holiday, there is no actual trading on that particular currency pair. So in other words, when it's an Australian holiday, you can still trade the US dollar against Australia, but it's not actually moving because it's based on the central banks. Now, the FX market is open 24 hours a day, 5 days a week, with most important world trading centers being located in London, New York, Tokyo, Zurich, Frankfurt, Hong Kong, Singapore, Paris, and Sydney. Now, it should be noted that there is no central marketplace for Forex. And this is what kind of weirds people out a little bit. That's hard for them to understand. There is no place like the S&P 500 or the Dow or the New York Stock Exchange or the FTSE or the London Stock Exchange. Okay. Currencies are not traded on an exchange. They're traded through a global network of computers that are hooked together in central locations. Okay. It's not like stocks where there is a central marketplace with all orders processed like in a New York Stock Exchange. Forex is a product quoted by all the major banks, and not all banks will have the same exact price. Now, the broker platforms take all these feeds from the different banks, and the quotes we see from our broker are an approximate average of them. It's the broker who is effectively transacting the trade and taking the other side of it, and they are the market makers for you. When you buy a currency pair, your broker is willing to sell it to you, not another broker. Now, what you have to understand is a long time ago, now currency has been traded or exchanged through governments since currencies became available. Before we had the Forex market, before we had retail investing, before we had speculation, still, if you had to go on vacation and you needed Swiss francs or you needed French francs before we had the euro, you needed to get this currency that you could pay your bills or pay for your trade, your trip while you were overseas, pay your hotel, pay for your dinners. Because go back before we had credit cards. I mean, it's a little hard to imagine, but people had to either have letters from their bank, and back in the old days, the wealthy traveled with letters of their banks, and they presented them to a local institution who then covered their debts in wherever they were traveling, and then it was cleared through the central banks. But currency trading started out by governments and the central banks of those governments so that they could pay the bills in the foreign currency. So in other words, if you were a U.S. company and you were transacting business in London and you needed to pay an invoice in London, say you had a New York office and a London office, and you had to pay that rent for your London office, you had to pay your employees in London in pounds, and you lived at your business, your central office was in the U.S. and all of your business was in dollars, you had to find a way to pay or move your money into pounds in the UK to pay your rent and pay those employees. Well, before we had computers and centralized trading and everything, you would process an international transfer that you would do with your local bank, but your local bank would clear it. This would take 3-5 days to actually move anywhere because your local bank had what they called a wire room. And your bank, the branch you would go into would fill out a whole bunch of forms with you. They would then transmit the forms down to their central office. Their wire office would then handle the wire to the central bank, the U.S. central bank, who would then send the money in pounds overseas to whatever clearing bank they would use, and it would then be finally directed to the bank you wish to place it into. It was all done by hand, and if the wire room at your bank, in whatever city you were, closed at 2 o'clock and you went to do the wire at 2:15, it wouldn't even get processed till the next day. This is the old days of banking because it wasn't there to make money. It was there to facilitate foreign exchange between governments and businesses. Down the road, speculators got involved in this, and all of a sudden we ended up with a currency market. But it wasn't this big retail market like we have today, because once we got computers and everything was easily available, you got more and more speculators in the market, and you got computerized trading, and all of a sudden it reached out to everybody all over the world that could start trading on computers in their own homes. Now, the first thing we have to understand is, what is the exchange rate? Okay. In other words, what is €1 worth? And like I said, your broker quotes you a price based on what several different major banks are offering for the euro. Because it used to be that it all had to go through the central bank, the Federal Reserve, and say if you were dealing with US dollars, or if you were in the UK and it would all go through the Bank of England. The bank would once a day set a rate for that currency or whatever the exchange rate was, and that would be the exchange rate till they reset it the next day. Today, that doesn't happen. The money's being moved without central banks through many big banks. Like if you deal with a small little bank that only has one office in a remote place, they might have to have another bank moving that currency and wait for that alternative bank to get it to them. But that bank, one major bank in the U.S., one major bank in the U.K. is, they went and typed in didn't even type in the wire. They went on a computer, did it in the office, or you did it online, and bing, 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 and seconds later, it's at the receiving bank. This means that the value of that currency isn't based on what the central bank set it at, it's based on what the value is at that moment, and it is continuously fluctuating. And the rates are changing. So it's important to know, like if you're going on vacation and you're in the US and you need Australian dollars, you could watch because the Australian dollar might be at 0.76 to the dollar, but it might be headed up because there's a central bank meeting. And if it goes up to 0.79, now if you're going on vacation and you're trading in your $1,000, it makes an insignificant little amount. Okay. For your $1,000, you got an extra $90 in Australian dollars. Okay. For $1,000, that's, I mean, no, you got an extra $9, excuse me. Okay. Well, it's a tiny little amount, but that's a big movement because currencies don't move that much. They move in thousandths of a point, tiny little decimals. But when we quote, or the exchange rate is, it's what technically you're buying or selling the currency you have. Not buying and selling the market. You have $1,000 US in your hand. Okay, forget the trading. We're not trading yet. You have $1,000 in your hand when you go to the bank and you say you need Australian dollars, and when you walk out of the bank, you have 1,200 Australian dollars. Now, that Australian dollar should buy you exactly what the American dollar should buy you. Let's take inflation, everything out of there, and price differences and duty. But technically, if you wanted to buy a pair of shoes, and the shoe manufacturer Nike sold them in the U.S., they sold them in Australia, and they were $100 in the U.S., they would probably be 110 Australian dollars. So whether you bought them in Australia when you got that extra few dollars Australian, you paid the same price. It just depends on what currency you were using. Okay. Now, when the Australian dollar is trading at 0.76, okay, you could wait till it went to 0.75 or 0.70, but it's a little bit of fluctuation because again, prices move in 1/1000th of a point, which is defined as a pip. So when the euro is quoted, it's not quoted at 133. It's usually quoted at 133.125 or 12. So it's 1.3312. And if the euro has a big move today, okay, it went from 133.25 to 133.50. That's a big move in a currency market. But in essence, if you're only getting $1,000 worth of euros, it would have made a difference of 25 cents. Okay. So you say, well, hey, how do I make money if I got to have 1,000 euros and it's only moving 25 pips and I'm only making 25 cents? Okay, we're going to talk about that in a second. But again, back to what the euro or the Australian dollar or the US dollar is trading at is when it's quoted, you have to understand how a currency is quoted. It is quoted in the base currency, which is your home currency, against the currency in which you wish to have. Okay. But there are also what we call majors. So in the US, around the globe, if you were going to trade pounds and dollars, it would always be the USD quoted against the pound, except if you were in London and it would be the pound versus the USD. Same value. It's the way the quote is handled. Okay. Because the majors, the big currencies, which are 7 majors, the euro US dollar, the pound US dollar, the US dollar Japanese yen, the US dollar Canadian, US dollar Australian, they're all quoted the same because they're called the majors. Okay. Now, if you were going to Australia and you had US dollars, we would quote it as the AUD-USD. Now, that would mean the AUD, which is on the left-hand side of the pair, is the base currency and you're trading it in for US dollars. Now, if you think the euro or the Australian dollar would fall, you would go short and you would buy dollars. If you were to think that the Australian dollar was going to go up, you would sell your dollars. Okay, now these are difficult concepts to get a hold of. But the cross-currency exchange rate between two currencies, both of which are not the official currencies of the country in which the exchange rate is quoted, is given in. The phrase is also sometimes used to refer to currency quotes which do not involve the US dollar, regardless of which country the quote is provided for. For example, if an exchange rate between the British pound and the Japanese yen was quoted in an American newspaper, this would be considered a cross rate in this context because neither the pound nor the yen is the standard currency in the US. However, if the exchange rate between the pound and the US dollar were quoted in the same newspaper, it would be considered a cross rate because the quote involved the US official currency. Okay. You kind of got to get used to it, and because I have students from all over the world, I kind of can't tell you what it is. But we have the majors, the US dollar, pound. But if you're in the UK, it would be quoted as the pound US dollar. But if you were in Japan and you were looking to trade your US dollars against pounds, it would always be USD/GBP is the quote. Okay, but it's a cross rate when it's not in your local currency. Now, Forex trading, as it relates to retail traders like you and I, is the speculation on the price of one currency against another. Okay, because we're not going to the bank and buying Australian dollars or buying pounds and handing the teller the $1,000 or the 1,000 pounds and getting something back in exchange. We are trading them. We're speculating on them. So for example, if you were to think the euro was going to go up or to rise against the US dollar, you can buy the euro-US dollar currency pair low and then hopefully sell it at a higher price. Okay. Of course, if you buy the euro against the dollar and the US dollar strengthens, then you will be in a losing position. So it's important to be aware of the risk involved in trading Forex, not only the reward. Okay. Now, imagine a situation where the US dollar is expected to weaken in relative value to the euro. So it doesn't matter at this point whether you're in Australia, whether you're in Canada, whether you're in South Africa, or whether you're in France. It doesn't matter what bank account you have, doesn't matter what you're sitting with in your broker's account has, because you're not actually physically buying or selling something. Okay, so you're not exchanging your local currency for anything, for a different currency. You are saying to your broker, I would like to invest in the euro-US dollar. Okay, because he's not actually selling you these, because you're not taking physical delivery. He's not converting your French francs. Well, it's your French euros now, but he's not converting your Japanese yen or your South African rands into those currencies. He's using your account as security, and you're saying, I'd like to buy the euro-US dollar at 1:012.15 because I think the euro-US dollar will go up and I will sell it when it gets a higher price. Okay. You're not actually converting or taking any of these. So if the euro strengthens, the purchasing power to buy the dollars has now been increased. The trader can now buy back more dollars than what he had to begin with making a profit. This is similar to stock trading. Stock trades will buy a stock if they think price is going to go up in the future, or sell a stock if they think the price will fall. That's basically all we're doing. If you think of the euro-US dollar as a stock, as a share, as a component, and you're saying this component is going to go up or this component is going to go down. Now, it could be that that component goes up because the euro gained lots of strength because something good happened, or the fact that the US dollar came down and the euro stayed where it was. Doesn't matter as long as the net value of that euro US dollar went in the direction you were hoping it would go. So in other words, if the euro US dollar was at 112.25 and you bought the euro US dollar hoping it was going to go up to 112.50, several different things could happen. The euro could have strengthened and pushed it up to 12.50, Or the euro could have had no effect at all, nothing in the headlines, nothing, but the US dollar went eased farther down or lost its value because something bad happened to the U.S. because Trump said something stupid. So the U.S. or the Federal Reserve didn't do something. So the dollar lost its strength and therefore allowed the euro to go up in value. Doesn't matter, or they could have both risen, but one risen more than the other. They're all extenuating, but in the end, all that you care about is that the euro U.S. dollar went in the favor or the direction in which you had selected it to go. Because you bought the euro US dollar at a low price and you're going to sell it at the higher price. Or the other way, if you thought it was going to fall, you sold it now to buy it back at a lesser price. Now, there are lots of people making up this market, this $7 trillion a day. So don't stop and think it's only guys like you who are investing in it. Because when you hear people walk away saying, I lost money trading Forex, believe me, the overall amount of people trading Forex don't lose money. You have central banks trading in the Forex market all the time. You'll hear that the Bank of England or the Bank of Japan just bought up because they're trying to shore up their currency, bought up billions of dollars, or they're selling because what happens is central banks end up with huge amounts of currency because they're exchanging currencies, doing all the transactions, bringing in the money. So they have huge reserves. And they will sell the UK, the Bank of England will dump their Japanese yen when the yen is very strong so they can make a profit in it. Then you have institutional investors. You have commercial banks. You have big brokers who are controlling the market. You have companies. International companies are constantly buying and selling currencies, because they have to pay bills in foreign currencies at all times. So they need to keep their money liquid and they need to have that currency at the lowest rate possible. So in other words, if you're in the U.S. and you import Hondas from, where do Hondas come from? Korea, Japan, wherever they come from, and you have to pay to the supplier in Japan $1 million or a million yen, say on the first of the month, well, you're not going to wait till the first of the month and gamble that the yen is high or low, because you could lose 10% of your value of your invoice. So you're going to buy up the yen when it's low because you know that you're going to have to pay a bill later, or you're going to use the yen you've accumulated over there. But companies have to, today, in today's world, it's all global. Companies are constantly balancing. They have whole departments who are not looking to make money in the Forex market. They're looking to keep balanced everything out so they can pay their invoices at the lowest price and not get hurt when the value of one of the currencies is miscued because they've got to pay a bill that's very high. Then you also have individuals like you and me. We actually make up the smallest part of the Forex market, the retail online trader. So hedge funds take up about 79% of all foreign exchange transactions and are speculative in nature. Then, of course, you have all the travelers who travel around the country, around the world, that are on vacation, buying and selling stuff, businessmen who are traveling. And then you have investment firms who manage large portfolios for their clients who are looking to make money. There's lots of people out there. But lastly, there's the Forex retail traders like you and me. Finally, we come to the retail investor. The retail investing trading industry is growing every day with the advent of Forex trading platforms and their ease of accessibility on the internet. Now, we've seen a huge revolution in Forex trading because Forex trading was quite complicated and very involved. There's all kinds of leverage and margin because you need leverage and margin in Forex trading, because would you bother if you had $1,000 or $2,000 or $5,000 or $10,000 to put in an account? And if I were to tell you, if you went and made $1,000 trade, if you wanted to trade $1,000 US for 1,000 euros, and it told you the euro might go up 3 pips today, but you have a risk of it going down 5 pips, well, that means for your $1,000 you could make $30, but you're risking losing 50. Okay. Well, the fact of the matter is, it's not worth all your time and effort to make the $30. And then in the old days before we had spreads, your commission took up a good part of that. So today you have to make more than you have to cover the spread. So therefore, you have to cover that spread. So not only would you make $30 and possibly lose 50, your $30 wouldn't even go to your pocket because your $30 would barely cover the spread. So you need to make at least $50 in your trade, but at the end of the day, you had a $50 risk exposure to net in your profit $20. Well, you're saying that's not even worth my effort and my energy. But if I were to say to you, okay, for your $1,000, I'll let you tie up 100,000 euros, and if the euro went in your favor by 50 pips, you'd make yourself $500. Yes, your loss probability would be still the same, possibility would be the same, depending on the risk management features you were selecting. But at least if you did all the effort, you spent a couple hours doing the research and everything else, and you figured you could make 500 bucks, maybe you can make 5,000, well, then it makes it worthwhile. So we get into leverage. And leverage is very important in this market because leverage allows you to magnify the amount of profit you could make. It also increases your risk. So don't misunderstand me. Just because you have leverage doesn't mean that you're going to increase your profits and you're not going to suffer any losses. No. Leverage and margin, leverage increases your profit and your loss potential in the same percentages. What it does is allows you to possibly make a lot more money, and therefore it makes it worth getting involved in the market. So as mentioned before, all trades are executed using borrowed money. This allows you to take advantage of leverage. Leverage of 50 to 1 allows you to trade with $1,000 in the market by setting aside only $20 as a security deposit. This means that you can take advantage of even the smallest movement in currencies by controlling more money in the market than you have in your account. On the other hand, leverages can also increase your losses. Trading foreign exchange with any level of leverage may not be suitable for all investors. Now, today with the development and the growth of what's called CFDs, contracts for difference, and that's what you would trade on the X90 platform. You can trade Forex in CFDs, but you no longer have to calculate the leverage. You simply have to decide how much you want to trade, and you don't have to consider, oh, I'm going to buy 1,000 euros. It's all built in for you. So you simply decide what you want to trade and what asset you want with the euro, US dollar. And you're saying, why is this important? I'm magnifying my losses. Well, maybe you think the euro is going to go up, but you're not sure if it's going to go up the dollar against the dollar, or it may go up more against the pound. Well, if you only had $1,000 and you only have one choice of the currency, well, that, you're stuck in a corner. But now with leverage as much as 200 to 1 or 400 to 1, depending on where you live, because leverage is controlled by the regulator in your home country. And because CFDs are regulated. So the amount of leverage is built in, but is based on what is legal under regulation. And because X90 is a regulated provider, it's what's available through your home country. Now, if you said, well, we think the euro is going to go up today, but I'm not sure if it's going to go up more against the dollar or the pound. You only had $1,000 to invest. You only could put $1,000. First of all, you're not getting enough investment to make it worth your time and effort to do the research or take the risk. But now if I say, okay, you could tie up 100,000 euros, you might say, well, you know what? I'll take one trade against the pound and I'll take another trade against the dollar. If it goes up more significantly against the pound, I'll make a bigger profit there, but I'll still make my profit in the US dollar. It allows you, if you want to have one trade over there for the pound US dollar, and then you see something else and go on with the Japanese yen, you can have another trade over there having nothing to do with the other trade. But if you only had $1,000, that's all you can be tying up. Now, You've only used a couple dollars of your account, and you can have multiple trades going on out there. So if you have 2 losing trades, but you had 5 trades going on, you had 3 winning trades, you still netted out some good profit. Now, so remember, you can open up a free demo account and trade your opinion and see how it works. Now, because you're trading in fractions of pennies, the prices are quoted in hundreds of a cent, and you can see how significant the return is, and this answer is leverage. Leverage is the ability to gear up your account into a position greater than your total margin, your total account margin. For instance, if a trader has $1,000 of margin in his account and he opens up a $100,000 position, he leverages his account by 100 to 1 or 100 to 1. He opens up a 200,000 position with a $1,000 margin in his account. He leverages it 200 times. Increasing your leverage also magnifies your loss. Now the thing with CFDs, okay, have all of this built in. You don't have to go out and calculate it all or figure out what the margin or leverage is. It's all built in. All you have to do is pick the currency pair you want to trade and how much money you want to invest, and it will do all the calculations for you. Now remember, when you're trading major currency pairs, okay, we have the major pairs which are called, you heard me when we were talking, I kept referring to the euro, US dollar. That is a major currency pair, and the euro, US dollar is just always referred to as the euro. USD JPY or USA Japanese yen is always called the dollar yen. The pound is always referred to as cable or sterling, the pound against dollar. Why cable? Because the cable ran from the UK to the US, underground telephone cables. The Swiss franc is called the Swissy. The Canadian dollar is called the loonie. The Australian dollar, the Aussie, and the New Zealand dollar, the Kiwi. And these are what are considered major currency pairs. You can trade what we call minors and then all the exotics. But these have the smallest spreads. They trade the most. It's where you get the most news, and it's the most popular, and therefore have the most liquidity. But if you want to trade the South African rand, you can trade them. But you find your spreads are larger, and it's harder to get the information on those assets. Not the prices, but the news coming out of there, the economic data coming from all of those other countries. And it's very important to understand everything that's happening about those currencies. So it gets harder and harder. Like you can trade the Russian ruble, you can trade the Chinese yuan. But the fact is, now with the yuan or the renminbi, we're starting to get more and more news out of China, economic news. Okay, but it's still very difficult to trade. Okay. Now you would need to understand how to properly read a currency pair quote. And again, like I showed you earlier, the left-hand currency is your base currency, and the right-hand currency is called the quote currency. So when we're quoting the euro, 132.105 means for every dollar you get 132, or for $100 you would get 132 euros. And then we have the bid and the ask price, which is the spread. So in other words, you have the price on the left, which is the price that someone or your broker is willing to sell it to you for. So in this case, it was 136.407. See how many decimal points all the way over there? So then you have the bid price or the sell price, and in this case it's 136.428. So that's the ask price and then the bid price. So it's the difference between the sell and the buy. And that is the spread. The difference between the two of them is the spread, because if you wanted to sell euros now, to close your trade, you'd actually technically be buying euros back. Okay, so therefore, the difference between the two is just like I was explaining to you at the bank. If you had bought one currency pair and they said, oh, no, we just canceled our vacation, can I have my money back? The next would be the buy. The difference of what you would lose would automatically be the spread. You've got, so in other words, when you're trading currencies, it's got to cover the spread. So in other words, you know that in this case, the euro US dollar would have had to move Now look at the decimals. We got 0.00021. Okay. And that is 1, 2, 3, 4. That's 1,000th of a point. This is 10,000 of a point. That's what the spread is. It's a tiny, insignificant amount. Okay, somebody asked, will I explain the 40? There's nothing to explain. The number is 136,407. 136,407. So since we always know what the euro is trading in as big points, this is the small points at the end. It's just one way to put it on the screen. So it's 136,407. So it's 136 and then all the way over to your, right, because that's the most, this is the points that is moving in. Because you already know the euro is at 136. It's not going to move except in very rare days between those, the numbers up top are very rarely going to change in one day. So these are the pips, the points to the right-hand side. So in other words, the 42.8 is 136,428. In the cell number, the 47 is 136. So it's just the amount of decimal points that it is over. Okay, now there's many things that affect the Forex market. There's things that political and economic stability, monetary policy, currency intervention, natural disasters, speeches and headlines. And this is when lots of people say, it's gambling. It isn't gambling. Because when you sit at a poker table, there is nothing that's affecting those cards except randomness. Okay. There isn't an economics report coming out. There isn't a jobs number coming out. There isn't a speech by a central banker. There isn't an interest rate decision coming up. Like tomorrow, we have a very big, important decision by the Federal Reserve, and they're probably going to raise interest rates. When they do that, the dollar is going to go up, gold's going to go down, because this is information. So you trade in the Forex market from information. Okay. Now, you need to have knowledge, and you need to acquire this knowledge to be a successful trader. Okay. But there are very few parameters that hinder your decision-making thought process. Market sell-offs and panic movements are yet to be experienced. Averaging out positions end up in giving up profits eventually. There's many things you have to know. You have to know what you don't know. But you can learn and conquer this market without much effort, but you have to put the effort in. So if you learn Forex trading properly, you can make lots of money. Forex can be a full-time job and make thousands of dollars every month. I have to emphasize again that if you start working on Forex before you learn it properly, it can be risky, and you can lose your money. It's like driving. If you don't drive a car before you learn to drive it properly, you will hurt yourself and others. But if you learn how to drive it properly and then take yourself getting confidence, you can go out on that road and drive safely most of the time. But you never know when you get sideswiped. So you have to be prepared for the risk at all times by carrying insurance. And you can make a lot of money by spending small amounts of money. Unlike other investments like the stock market, you have to invest a lot of money to make a real profit. You can make good income through investing small amounts of money. It means you don't have to have a big account. You start with a small account and grow it after time. But it does take time and effort. And on that note, I'm going to say goodnight to y'all. Thank you very much for joining us. This class has been recorded. If you want to see it again, just use the link you came in tonight, but you have to give it about 24 hours to get up there and post it. Thank you very much, and have a good night.